we're still on a sell. We're bouncing off support. This doesn't mean it's a buy. Don't go rushing in to buy the market. It's got to hold here for the week. And what would be ideal is that sometime during this week, we actually rally back above the 20-day. Then you can look at that 50 and say, hey, yeah, we held that 50-day support. That's a good buy. And we'll eventually move the buy signal back into place, and you'll be able to add money to portfolios for the end of the year. So, we're looking at this very closely right now. Your next opportunity to buy for the end of the year rally will be when we get the next buy signal.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap featuring my good and phantasmal friend, Lance Roberts. Lance, how you doing?
I'm good, and I am phantasmal this week. So yes, absolutely.
Good. I had to go for the Halloween theme. We have some jump scares that hit the market this week. So lots to talk about. But the big question on everybody's mind is, I think it was like a year or two ago, we had that picture of you dressed up as Spider-Man for Halloween. You always go big. What'd you go as this year?
Actually, I did a reprise. So it was 2 years ago, I did Spider-Man. Last year was Master Chief from Halo. And since this is a new neighborhood, I reprised Spider-Man this year because we have tons of little kids, and a lot of little kids today don't know who Master Chief is. So I reprised Spider-Man. It was a big hit in the neighborhood. So yeah.
All right, great. I'll see if I can get you to send me a photo, and if you do, I'll put it up on the screen there for folks. All right, well, look, like I said, some jump scares in the markets this week. One is just the day we're talking here, Friday morning here, we got the new payroll numbers, pretty shockingly low.
Yeah.
Total, what, 13,000 jobs? If you take out government jobs, actual private market jobs shrunk for the first time in years with a negative print.
Yep.
So anyways, markets are digesting this. Markets being what they are, bad news is good news. They're up so far today. But what do you take from this big jobs miss?
Don't take anything out of this report. You had Hurricane Helene, Hurricane Milton that took tons of people off the rolls. They couldn't go to work, weren't able to work. You also had a lot of people that were working, like linemen, construction workers, trash removal workers, et cetera, working overtime. So that all impacted the hours paid as well as the number of hours worked in a week. So, the more broader issue was the negative revisions to prior months. We revised last month's down by, I think 31,000 the month before that. So total negative revisions were like 112,000. So that's more important. Again, the employment growth isn't as strong as we expected or as was reported, but we kind of already knew that just from the economic data. But the reason the market's up so strong today is that they're looking kind of through this number and looking at what the Fed's going to do. The data reports on personal consumption expenditures, GDP, et cetera, really kind of open the pathway for the Fed to cut rates 25 basis points next week. So markets are rallying on that. And also remember, and when we get into the technical part of this in a second, we've been warning about that sell signal for a couple of weeks, and that finally matured yesterday. We had a nice big sell-off yesterday. So markets are really just kind of bouncing off support today. So again, markets really aren't looking at the employment number at all. It's more of a technical issue today.
Okay, so today's bounce you think is more technical. Although to your point, I think people are saying, oh, well, we were concerned that the Fed was losing its justification to continue rate cuts from here. A weak payrolls number gives it more opportunity to cut, and that's where the whole kind of bad news, good news is good news comes from.
Yeah. And clearly, the markets are still rallying on the hope that the Fed's going to cut rates, and again, there's really nothing to deter them. We've got a lot of data to get through, though. We had the employment report today. Tuesday is the election. Wednesday is the FOMC meeting. Next Wednesday, CPI. So there's potential for a lot of volatility in the market from just news-driven headlines over the next really kind of 2 weeks.
Right. And that's, of course, assuming we know relatively soon next week who the winner of the election is, right? If it's a protracted fight, there could be a lot more volatility. Yeah.
Absolutely. That's, we've been talking about kind of like the seasonal buy signal, those type of things. Those are still in place right now. And, we have corporate buybacks that started really literally today, on Friday. Corporate buybacks, that window opened back up. That's $6 billion a day going into the year. You got performance chasing, year-end window dressing. So you got lots of reasons for upside bias. But as we've been talking about, there is risk. And even though the bias is to the upside into over the next 2 months, to your point specifically, is that if we get to a highly contested election that drags out until December, that could, really kind of put their markets turmoil. Good historical relationship to that was back in 2000 when Al Gore and George Bush were running for presidency. And then in Florida, there was the hanging Chad issue that wound up going to a contested election that wound up going all the way to the Supreme Court. And that got kicked back to the Florida courts. And when it got kicked back from the Supreme Court, Al Gore said, I give up. It's fine. We just need to move on. But the market was down about 8% between November and December when that contest was going on. Now, that's the only kind of really recent market contest that we have to deal with where there was a contested election. They don't happen very often historically. You have to go back like 1937 before that. So again, there is risk, and I don't think we can, particularly in today's very highly politically charged climate, I don't think we can ignore the risk of a contested election. Plus the fact that both sides, and find it fascinating. One they're always saying is like, are you going to accept the outcome of the election? And trying to say the other side isn't, but they're both filing up. Both sets of lawyers on both sides have now prepared all of their legal filings. So you can almost guarantee that unless this election is a blowout, if it's fairly close, there's going to be election claims filed, legal challenges filed by Wednesday morning.
Got it. Yeah, no matter what the results are. Just making it, even more of a tight race is the fact that the polls are now tightening again. They've been super tight, some of the tightest folks have ever said, but Trump appeared to be had the momentum, was beginning to rise in the prediction markets or whatnot. On the day we're talking, that is tightening again. So this race is going to be a nail biter, lawyers aside, but likely the lawyers are just going to make the nail biting factor even exponentially worse.
Yeah, but be careful. The poly market polls, they're not reliable. Those are big whale bets that are moving those polls. Yep. So I wouldn't pay attention to those. The other polls have been terrible, and since 2000, all the polls have been terrible predictors of outcomes of elections. What happens in the election is often very different than what the poll said. But I saw an interesting article, and I think this is a true statement. They interviewed a whole lot of a big pool of Gen Z voters and a big pool of millennial voters, and they go, "Who are you going to vote for?" And they go, "We're not telling you." In fact, when we talk to our family members, we don't even tell them the truth. And because everybody's afraid to say who they're voting for because they don't want the reprisal from it, either online or
right. There are even some campaign ads that are playing on this now that have been coming out recently, right? Yeah,
Yeah, and so my point is I don't think you can trust the polls at all. I mean, we're going to find out what the election looks like come Wednesday morning, and I think we'll have a decent idea of that. But again, election aside, right? It's really not the president that matters. It's who controls the House and the Senate, and we're going to know that pretty certain by Wednesday morning. And I think the markets will, if there is a contest between the presidential seat, if the House and the Senate are split between, as an example, we have a Republican House and a Democratic Senate, or vice versa. If you've got a split that is set up in the House and Senate, I think the markets will start looking through the fact that whoever's elected president, it's not going to matter a lot because no policy is going to get passed.
Going to get passed, right?
Markets will like that.
Right. So markets like gridlock. Yeah.
They love gridlock. So, regardless of who's president, if you go back and look at history, the best market returns in a presidential election year come when you have it doesn't matter who the president is, Democrat or Republican, the returns are almost identical having split Congresses, and they're generally up, 13% a year. So, okay. I think that's going to be the real key thing that I think as investors we should look at on Wednesday. Don't worry so much about the president, worry about House and Senate.
Okay. And right now, and I know you put in your caveat about the polls, looks like the Senate's going to go Republican, House much more of a toss-up.
Yeah. And don't forget, Michael Leibowitz made a great point this week. We were having this conversation. Let's just assume that, for instance, Republicans capture the House and the Senate. Okay. So markets may not like that so much. However, you've got the Republican caucus, the Freedom Caucus, that's in the House, and they're really anti-debt, those type of things. So, if you've got, say, a Republican-controlled House, it won't be by a huge majority. And so it only takes 4 or 5 of the Freedom Caucus, as an example, to push back against spending or any type of bill that might increase the deficit. That, and of course, whatever, let's just assume for a second that President Trump, gets reelected and he wants to pass, trade tariffs or, a big deficit spending bill, whatever it is. Well, we know for a fact right now, just past history tells us that all the Democrats will oppose whatever bill he proposes, right? That's just the new game plan in Washington. We no longer have bipartisan anything. It's just a function of, if I don't like it, everybody votes against it, or everybody votes for it, based on party affiliation more than anything else. So it won't take many, people in the Freedom Caucus, as an example, to vote no for whatever bill it is, and effectively you still wind up with gridlock in Washington. So just, it's not, and
right.
Like I said, there's a point by Michael Leibowitz, because again, just because you get Republican-controlled House and Senate, you still don't really have full control because of that Freedom Caucus.
Okay, so don't assume that a clean sweep means a green light for everything that the incumbent wants to do. Absolutely. All right, well, to your point, I'm really looking forward to, hopefully next week, that we'll know who the winner is, that it is by a wide enough margin that we don't go into national, craziness, and that, markets and all of us can start determining what we want to do based upon what we now have confidence the new playbook's going to be.
Absolutely.
And we can stop talking about the election too.
That would even be better. I'd love that. No, I look at some point we've got to just start coming back together as a nation, and just start, stop with all the rhetoric and all the BS, and just start focusing on, we need good policy. I'm really looking forward to the fact that, after this election, we kind of get washed out of most of this old cycle that we have. And we get guys.
You mean in terms of politicians, they're going to age out of a lot of the.
Yeah, they're just aging out. So we're going to finally get past kind of that group of individuals. And, there's a lot of really impressive younger senators and congressmen that are coming up that will make fantastic candidates on both sides. And will hopefully kind of start moving us away from all this vitriol and start moving back to what's important, is that we need Congress and Senate that actually works together to pass bills for the good of the country.
Yeah, well, look, from your lips to the universe's ears, my friend, we've railed about the gerontocracy on Capitol Hill for a long time, and it would be wonderful if we can start passing the torch to some younger talent. All right, well, look, we'll note. Whoops, sorry, go ahead.
I was going to say, fortunately, time is going to solve that problem.
All right. Well, look, let's move on from the election, but that was one of the big topics here on the list. We talked about payrolls. Let's talk about some of the weakness we saw this week in big tech. So we saw Apple, Microsoft, Meta, and NVIDIA all had, relatively rough weeks. Now, it's not any sort of crisis or anything at this point in time. But each of them saw a number of them gave out earnings. Obviously, people didn't like the future projections enough that the companies got dinged after hours. Now, bucking the trend was Amazon, which has had a pretty darn good week. And Google was up, and then it kind of came back down. So anyways, we're at this point where, or everyone's wondering if we're getting to this point where, hey, the AI freight train that's just been pulling the whole markets along with it, is it tapping out? I don't think we know yet, but I'm curious, what if anything do you take away from the softness we saw in these big names this week?
Not a lot. I mean, just from the function that, again, you're looking at price action for, the day, and that's fine. But if you take a look at these earnings reports from, and by the way, NVIDIA didn't report earnings this week. They don't report earnings like November. They were swept up more in the AMD report, which, by the way, just full disclosure, we own AMD, we own NVIDIA, we own Microsoft, we own Google, we own Amazon, we own Apple, and we own Microsoft. Yeah. So, and we own Meta, depending on the portfolio. So just full disclosure, we own these stocks. But what's important is that if you take a look, so again, you go, I'm looking at price, and you're making an assumption from price that, is the AI trend bumping out because the price has been choppy. These stocks have had huge runs, and Wall Street has gotten very optimistic that they're just going to keep coming out and just doing these astronomical projections. AMD doubled their revenue, doubled their sales. They are gaining market share. They are firing on all cylinders, and they kept their guidance where it was, which was already very, very strong for the rest of the year. And Wall Street was disappointed because they didn't say, well, not only are we going to do this great over the next year, we're going to multiply that by 6 times. And just Wall Street has gotten so aggressive and optimistic on these things that simply there's almost no way a lot of these companies can win. But if you look at the underlying earnings growth, for instance, Microsoft, they're growing their cloud-based business at 31% a year. That's huge. For a company the size of Microsoft, to grow your cloud business at 31% is not chump change.
It is bananas, yeah.
So, look, these are, and you should welcome these corrections. AI is not tapping out. The spending by Amazon and by Microsoft is not slowing down at all. I'd be a buyer of these. I'm hoping these stocks dip some more. I would love to get these things to pull back 10, 15%, if not a little bit more, get back to some longer term support, work off some of this more extreme overbought condition. And then I'll add to the positions in the portfolio. So yeah, just at some point, we're going to get a really decent oversold weekly and monthly basis entry point for these stocks, and yeah, be buyers for it.
Okay. So again, I asked the question in the spirit of, there are some out there, and I'll put Fred Hickey, on this list, who said, hey, look, there's a reckoning coming to AI. It's been a bubble. It's going to, once the world wakes up to that, you're going to have a massive downward repricing. Sounds like you're saying, we're not seeing any signs of that yet. Then there's my comment, I think I made the other week, about once your team starts winning the Super Bowl, after a few years, then you just start expecting it's going to win the Super Bowl the next time around, right? And so one of the questions is might prices have to come down just because too much euphoric expectation is in the stock, because you can't win the Super Bowl every year? Yeah.
And again, you take a look at Google as a good example. It's been correcting since July. So prices are coming down. It's working off long-term overbought conditions. It's consolidating in a good range. Those are the type of things that you want to look for as an investor. And look, I'm not arguing with Fred Hickey, but it's way too early to call that you're in a bubble for AI, because this thing is really the build out for AI and data centers and all the stuff that's coming down the pipeline. That's just getting started. And then you throw on top of that, hey, we're going to start doing, if we're going to start doing more robots from Boston Scientific or Tesla, whoever's going to do the robot thing, there's so much technology that's now growing at such a rapid pace. It's all going to be demanding these same products on the road. And basically, this all comes back to data center, data housing. And that's going to be a dynamic that is much like the internet was back in 1999. It was interesting, when I hear the comments from people like Fred Hickey, I remember those same comments in 1999. I was like, the internet's a bubble, it's a fad, and it's not. It won't be here very long. And yeah, it went through a good correction in 2000. We washed out all the trash companies, and then the ones you wanted to own survived that. And those are the ones that if you bought, you've made an absolute killing on, because the internet is now ingrained in anything. And that's the way AI is going to be. AI is eventually going to be a function that it's in everything we're doing. It's going to be a part of your daily life. Everything you touch, do, use, operate is all going to have some function of AI tied into it. Drive, your phones. And so, like the internet, we're going to go through a correction at some point in AI. And Fred's right, is that we're going to see a washing out of a lot of these smaller companies that are trying to come to the space. Private equity is funding hundreds of AI type companies right now. The vast majority of those will fail. They will never go to be public. So be careful what you invest in. But there's other companies that are going to thrive. And what the difference was between today and for instance, 1999 is back in 1999, 2000, a lot of those companies didn't have revenue.
Didn't have, revenue earnings,
Just take a Meta as an example. You say, well, the metaverse is going to be a terrible investment. Nobody's going to use the metaverse. I'm not saying that's the case, by the way. And we own Meta in our dividend model. But the Meta could completely flop. but that company still generates a crap ton of revenue. And that's, by the way, that's a legal financial term, crap ton. So completely legit.
I think Benjamin Graham came up with it, right? Yeah.
It was back in the day. But yeah, so they generate a ton of revenue. The business is not going out of business because they generate so much money on advertising from the internet. So yeah, the Meta may be a bust. They may wind up having to write off. And I'm not saying, I'm not saying that's the case. I'm using it as an example. So don't go freak out on me.
Hypothetical.
Don't send me a bunch of emails about how Meta is going to rule the world. But I'm just saying they could write off that entire division and they would still be a viable company. So, those, and that's the differential that we have to really equate is that, yes, the AI bubble or the AI chase is going to slow. You're going to bring more competitors to markets. They will eat into market share ultimately. But again, what we want to bet on is the companies that are winning that space, and then we can speculate in potential newcomers that might gain a significant market share in that environment. And I think there's going to be some of those companies. We just don't, they're not around yet. But the next Apple, Metasoft, Google, Microsoft, Meta, Google, whatever that company is that's coming, we'll eventually find it, but it'll be a while.
Yeah, yeah. And look, just to be super clear, smart people have different opinions. So not saying everybody has to agree with Fred. I'm just saying that I'm representing his point of view because it is shared by a percentage of investors out there, which is, hey, this is overhyped. There's really not that much there, at least yet. And one of the things that Fred talked about in depth at our recent conference was, he's really beginning to see a lot of reports from CIOs and purchasing managers saying, hey, look, we're just not seeing the type of returns that we need to see at this point, given how much we've been investing in here. But that's just one point of view, right? And of course, you're saying we're not seeing evidence of that yet. But I just want to share my screen real quickly because today's a really good example. So here is a headline just from a few hours ago, Reuters. Big tech's AI splurge worries investors about returns, right? So it's exactly what I'm talking about. Companies just spending hundreds of billions on this space, and people are saying, well, where's the monetizable result from this? We've been doing this enough now that we hope to see some at least initial signs of the type of returns that we want. I think Fred quoted some stat. I don't have the exact stat in my mind, but I think it was something like, some of these CIOs were saying like 90% of our AI projects aren't making it out of the lab. Like they're not graduating to prime time. Now you contrast that with this headline from the Wall Street Journal, also from a couple hours ago. Tech giants see AI bets starting to pay off, right? So, if you're an investor reading the news right now, you're actually getting, quite conflicting headlines here from folks. And I know, Lance, you always say don't get too caught up in the headlines, but it is interesting that we've got people on both sides saying it's great, nope, it's not, and I guess it's just going to take a while to find out.
Well, no, and look, and let's just let me go back. Look, I admire Fred Hickey. I think he's a very smart man, and I'm not saying that he's wrong. I'm not saying any of that, right? When we do our work, and again, we're not running an AI portfolio, mind you, right? So we will have one in the first quarter. We're going to have a portfolio that's dedicated to AI, probably around Q1. But right now we don't. We are invested in companies that have exposure to AI. But the reason we own Microsoft, Apple, Google, Amazon is not because they're exposed to AI. That's not why we own them. We own them because they're 37% of the index. And if I want to chase performance, which I've got to create for my clients, I need to own the stocks that make up all the passive flows. So, my bets on Apple, Amazon, Microsoft, Google are not an AI bet. It's a function that I understand passive investing and I understand the impact it's having on markets. And we can debate on the benefits of AI. But again, at the end of the day, if Amazon came out tomorrow and like they just had their report, Boomer report, they said, we're seeing tons of results coming from AI already. Walmart made the exact same comment, which is both good and bad, by the way. Walmart said, our AI is doing analytics for us that's saving us a ton of money. It's a technical crap ton of money. And the report, crap ton. Not really, but they said, the AI is doing work for us that would normally take 100 people to do. that is so cost efficient for Walmart. That is going to lead to expanding profit margins, expanding ability to manage their inventory flows, their customer traffic reports, all those type of things. Now, you eliminated 100 jobs by the way, so don't overlook that part, right? Where you're getting rid of a lot of jobs. But these companies, again, you're not going to get away from the impact of AI ultimately in the impact of basically everything you touch or do. We're by the first quarter of next year, we're going to have an entire AI run model that picks the buys and the sells for you and generates the model. So all AI driven. It'll have no human intervention whatsoever. So
it's going to be super interesting to see how that performs versus the human. It's going to be the modern John Henry versus the steam jackhammer, right?
Yeah, well, let me give you a couple of good examples. It picked AbbVie back on October the 17th, which has had a monster move since then. So and we're going through all and by the way, just today, just picked Duke Energy this morning. So we'll see, we're going to monitor to see how it does. But so far, its track record is running about 75% on its picks, which is, if you can get 75% on your picks, you're going to do fine.
Oh, you're going to do great. So it's interesting, Lance. It's been nice talking with you, buddy.
Yeah.
I feel like in a year, it's going to be my AI generated avatar talking to your AI trading system here for folks on the channel.
Yeah, don't laugh at that. That's, I've seen a lot of these, on TikTok and everything else, all these, kind of videos that are put out that are all AI generated. It's pretty incredible.
Yeah. All right. Well, look, so last point on this, and then we're going to move on to buybacks, which is, the reason why it's so important to focus on these big companies and the ones that are, representing most of the AI generated market value is because their direction, given the markets we now have, right? You always say you got to trade the markets you have. Given the markets we now have, the trajectory of those companies is essentially the trajectory of the markets, right? And so that's why we've got to pay such close attention to this. Okay. So buyback. So you mentioned, you've been telling us that the buyback window was going to start opening at the end of October. It is now starting to open. There's two charts I want to share real quick, and then I'll let you react, Lance. So one is, you mentioned many times that there's a seasonal, there's usually a seasonal run up in the end of the year for a lot of the reasons you mentioned: Santa Claus rally, repositioning, all that type of stuff, window dressing. But that tends to be pronounced in election years. So here's a chart. I took this from Gordon Long. It looks like it's from Haber Analytics and Deutsche Bank. But you can see here the general seasonal pattern here of the year. And this black line, vertical black line here is election day. And you can see how, on average, this is a composite, the market tends to have its best performance in these last 2 years running from election day up into the year. So we have that seasonal tailwind coming. And at the same time, corporate buyback windows are opening. You can see on this chart here, 10/28. So that was just a couple of days ago. Right. The amount of expected buybacks to come now is going to be pretty prodigious over the next 2 months or so here. So we have that potential strong tailwind as well. So seasonal plus buybacks reopening. Again, you can't take this stuff to the bank, but it does help you with your probability assessment of what the market's likely to do from here, correct?
Well, no, absolutely. I mean, you've got $988 billion of buybacks announced for this year. 21% of those have been executed between November and December. So that's roughly $6 billion a day. That's not chump change. And the market, last time we talked about this was last October when the market bottomed. We had that 10% correction last year, and you and I were talking about why we'd rally into year end. And the analysis back then was performance chasing, window dressing, and ultimately stock buybacks, which was only $5 billion a day back then. So you got the same exact setup this year. Post-election, $6 billion a day, performance chasing. A lot of money managers are behind their benchmarks this year. And then you just have the general momentum of the market. People don't want to be left out. They want to be in the markets. They think the markets are going higher. Consumer confidence on higher stock prices in the next 12 months, highest level on record. So despite the fact they're not very confident about the economy, they are hugely confident about the stock market. So, there's just a need to be invested at this point, which is you're just going to get a lot of money chasing money into the end of the year. And this is across all risk assets. Gold, Bitcoin, stocks, they're all running a very high correlation. Good example yesterday was market sold off one, gold sold off as well. So, I mean, it's just Bitcoin sold off, everything sold off yesterday. So again, everything's just very highly correlated, and there's this need to chase those assets because everybody's like, look, I'm missing out. I've got to be in the markets now because I'm missing out. I've been sitting on the sidelines, whatever I'm doing, I got to be in. And that's just pushing these asset prices higher. And that's not going to end anytime soon. It will end. Now, mind you, will end. There's some really good analysis this past week. We've had the best the market's up 40% over the last 12 months. It is the best risk-adjusted return for the stock market on record. The only times other than this were in 2018 and in 1997, 1995. And of course, eventually those risk-adjusted returns failed, but it took time, right? I mean, it takes time. The thing about momentum is like a speeding train, and it takes a long time to slow a speeding train down.
So let's spend a second on this. I know we've talked about buybacks in the past, and you just were out today, I think, with a new post on it.
Yeah, a huge debate over the buyback, so I had to write another article.
But sort of the person who just says, well, I mean, Lance, isn't this great? Can't this just continue forever? Like, if we're getting phenomenal market returns like this driven by all this spending, why don't we just keep doing it forever?
Well, yeah, I mean, that's the goal, but eventually,
I'm sure they'll try, but how does reality insert itself here?
Well, the reality is at some point, every company's private that buys back their shares, because when I'm buying back my shares, I'm reducing the number of shares outstanding on the market. Well, there's only so many shares outstanding, so if I buy them all back, I'm no longer public.
All right, but let me ask this. So let's say you do that. Let's say one of these big companies does this, works so well for them, they keep goosing their share price higher until they're fully private. Don't they have a huge incentive then just to do a big IPO and get even more money? Just keep repeating this cycle.
As long as it keeps, as long as the wheels keep turning. But look, at the end of the day, so there was this huge debate about buybacks. I posted this comment on X, which I shouldn't have done. But I was like, look, buybacks are a terrible use of capital, and they're not a return of capital to shareholders. They're not. The reason it's not a return of capital to shareholders is very basic. Apple buys back its shares. Did you get a check in the mail?
Right. No. Yeah.
No.
It's their.
When Apple issues a dividend, you get a check in the mail. Yeah, you do. Well, you get a deposit into your account, but let's call it check in the mail. So dividends are a return of capital to all shareholders. A tender offer is an optional return of capital to all shareholders. So when a company does a tender offer, they send out a letter to all shareholders and say, we're willing to buy our stock back at this price. Everybody has the right at that point to sell their shares back to the company. That's a return of capital to shareholders. Problem with buybacks is it's mostly involved with insiders because they have an ability to really kind of navigate what's happening with these insider shares. So the SEC did a study on this, and the vast majority of share buybacks are done by insiders to create their compensation. They sell back their restricted stock units, their options, et cetera, that they've got out there. And of course, it's all benefits their compensation. So, and that's one thing I was showing in this article. So who benefits the most from share buybacks? Timing of insider sales, because they know when these buybacks are being done. So they can time the sale of their shares based on those buybacks. They can boost their EPS per share, which unlocks the bonuses for all these executives. And they have offsetting dilution from the stock options. So that all benefits that. And that doesn't really prioritize the return of capital to shareholders. It's more of prioritizing the return of capital to insiders. So again, alternatives to buybacks, the way to really return capital, tender offers, dividends, and long-term investment growth, which grows the company. So to your point, Adam, what's the negative to all these buybacks? Well, I'm not investing in growing my business, creating more lines of product, growing my market share, employing people, which provides wages and better economic prosperity. Buybacks don't lead to economic prosperity. It reduces economic prosperity and creates more of the wealth gap, which is what everybody complains about, but it's directly a function of what's going on with buybacks. So there's so many better ways to use that capital. And again, we're talking over, we've spent between 2003 and 2023, companies spent $11 trillion doing buybacks. Now, there's nothing wrong with it. I'm not saying that that's their right to do it. They're a company, it's their capital, they can do whatever they want with it. But what if they spent that $11 trillion doing things to expand their business, grow their business, create jobs, create opportunities, make investments in new companies that are coming up, create other opportunities within the economy? How much better off would the economy have been with that $11 trillion rather than just recycling it through executives and insiders? I mean, that's the whole point, right?
Yeah. So let me ask you this question then, Lance, which is, we've talked about this before. You're not the only guy, I'm sure, that realizes this. And if I can distill what you just said in a nutshell, it's we're taking mutual shareholder value, and we're putting it in the pockets of corporate insiders. That's essentially what it's doing. It's an extraction, right? We're going to take capital that we all have, and then we're going to just give it to these corporate insiders, right? Because they have X amount of shares, and we're buying back those specific shares. I don't think it takes a rocket scientist to say, okay, yeah, that's not really investing in the future of the company. That seems like it's being very selective in terms of who it's favoring. In some ways, it seems like, some could say it is almost sort of theft. You're taking a common asset and you're giving it to a select few. Especially with these other forms of doing what we think buybacks are doing, which is taking excess value and returning it equally to everybody who owns the company, whether that's through dividends, whether that's through tender offers. Why don't we just do that? Why isn't the SEC stepping in here and saying, hey, you know what, this actually seems kind of dubious. You have these other pathways that are much more fair. And as you've said many times in the past, buybacks used to be illegal, right? So why not just say, hey, wait a minute, we don't like the extraction. Let's start telling companies you got to use some of these other more fair routes.
Well, again, that would be
because DC is captured and the regulators are paid off by all these companies.
Look, there's certain, certainly when you talk about, so who controls the SEC, it's Wall Street, right? So it's all the major firms of Wall Street really kind of control the regulatory environment of the SEC. And the reason I say that is that, so the SEC, they're going to pass this rule, right? So they say, okay, we're going to pass a rule that basically outlaws stock buybacks. Well, they put that out. They don't just pass the rule. They put it up for comments. And of course, then JP Morgan and Goldman Sachs and everybody else say, oh, no, this will be a terrible rule. If you do this rule, it's going to create financial havoc within the markets and yada, yada, yada. Of course, they're going to say that because that's the way stock buybacks are done is they are basically set up through the investment banking firm of that company. And so they're working together. So there's huge monetary incentive for Goldman Sachs or JP Morgan to execute these share buybacks. And so, yeah, of course, they're going to push back. So the SEC goes, okay, we're not going to pass this rule because we were told by our commentary out there when we put it out there for negotiation that that's going to be terrible for the market. So they don't do this. They did the whole same on high frequency trading. They put out these rules that they were going to do, and they were all shot down basically by the big Wall Street firms who benefit from high frequency trading. But that's just the way the system works. And we just have to understand that. But the reality is, and again, let me just back all this up real quick and just reiterate the fact that there's nothing wrong with doing buybacks. It's the company's right to do it because they're illegal right now. They used to be illegal. They are illegal.
It's not illegal. We're talking about the morality of it, but yeah.
Morality and really, but more importantly, as a shareholder of these companies, you should not want these to be done this way because it really distorts the future value of the company. One of the argument is, and this is the argument that is most often thrown out there. They go, it's a return of capital to shareholders because people now own more of the company than they did before because they've reduced the number of outstanding shares. And the reason everybody buys off on this thesis It's kind of like saying high yield. Rather than saying junk bonds, we say high yield bonds, right? That sounds better. It's a good marketing term. Return of capital, buybacks or return of capital shareholders is a good marketing term for what's going on. But basically, you're diverting capital from productive growth for the company. So as a shareholder, I should be saying, look, if you want to buy back your shares, do a tender offer. If you need to do something with your cash because you can't figure out a better opportunity for your cash, return it as a dividend to me, right? So all shareholders are treated equally.
Right.
We should be saying as shareholders of these companies, but because we do buybacks and the stock price goes up, we go, oh, this is great. So the stock back drive prices higher. It's all good. But again, it's a function of these buybacks being done at accretive prices. Warren Buffett made this comment in his last annual investor letter. He said, the math isn't complicated. When the share count goes down, your interest in our many business, because Warren Buffett does buybacks too, by the way, your interest in our many businesses go up. That's the argument. It's a return of capital shareholders because your interest in the businesses are going up. Every small bit helps if repurchases are made at value accretive prices. Now, this quote is his, not mine. Just as surely, when a company overpays for repurchases, the continuing shareholders lose. At such times, gains flow only to the selling shareholders and to the friendly but expensive investment banker who recommended the foolish purchases. Gains value repurchases, if it should be emphasized, benefit all owners in every respect. So the buybacks that are being done by these companies are not being done at value accretive prices. And interestingly enough, when their share prices are going down, they stop doing buybacks. So the very time they should be doing buybacks is when they don't. Why don't they do them when their share prices are going down? Because all of the insider stock options are out of the money.
So buybacks don't help in the way,
correct. So there's no benefit in doing the buybacks because all the options are out of the money, and so nobody money.
And that's what I think is so nefarious about this, and this is why I really wanted us to dig into this, is as long as the tide is rising, right, the markets are being driven by multiple expansion the way they are right now, this totally works in the favor of the insiders. They're totally happy to do it. As you said, yes, your ownership in the company increases, but it's a diminished company that you're getting the increased ownership of because they've extracted real value from it, and it's value that's not being reinvested in to grow the company, right? So its prospects are actually diminished, right? So you're getting a little more of something that's more than a little less, right? But the average person is told, well, don't worry, because your share prices go up when we do this, and that's the tailwind of multiple expansions. They kind of pat them on the head, and the person's like, oh, good, I'm just looking at my stock and it went up today. This is good. Buybacks are good, right? Pardon me?
It's high yield. That's great.
Yeah, it's high yield, exactly. So and then of course, if the worm turns, which it inevitably does at some point in time, you realize that the company is much more hollowed out than it otherwise would have been. And the insiders, they're disappointed because the game isn't continuing, but they're crying all the way to the bank because they've extracted all this value along the way. So they're going to be fine.
Yeah, no, it's right. Look, and again, it's just, these are narratives, and they're great narratives that come around, in a bull market. And like I said, I got into this debate with Lynn Alden on X, and we were going back and forth over this. But the reality is, ultimately, at the end of the day, is that buybacks, again, they're legal. You can classify them however you want to do. What we don't know yet, and we won't know for several more years, maybe more like a couple of decades, is what the true value of all these buybacks actually was. And again, when we start looking, and when we look at economic prosperity, if we look at the kind of the country, we look at wage growth, we look at just broad, the wealth of the average American. Again, capitalism should be lifting all Americans higher, not just a select few. So over the next couple of decades, we're going to look back and go, yeah, we spent trillions upon trillions of dollars doing corporate share buybacks. Why? When all that capital could have been used for something else. And again, my big complaint comes from like Boeing in 2020, when we had this big financial market crisis. We shut down the economy. Boeing goes to the government begging for, please, sir, can I have a bailout, please? But they spent 5 years spending all their capital doing buybacks. So when the crisis happened, they had no capital to bail out. They had to go to the taxpayer. And so then this has become playbook, right? We did this in 2008. We did it in 2020. We're going to do it in 2026 or whenever the next crisis is. All these big companies that have spent decades doing buybacks, spending all their capital in that, they're going to go to the government begging for a bailout and taxpayers will be on the hook. That's my problem with buybacks.
Yeah.
Right.
And that's the moral hazard of bad policy, which we talk about all the time, right? You keep rewarding these guys out. Of course, they're going to continue doing it. Why wouldn't they?
Yeah, absolutely. So anyway, enough of that. But anyway, there's an article on our website today talking about how buybacks are done, how it actually works, and what better alternatives are.
Okay. All right. Well, look, Lance, let's if we can, let's get to what the TA is telling you. If you want to pull up your charts there. So last time we talked, if I'm remembering correctly, because the buy and sell signals have been bouncing all around. I think last week it was seasonal buy signal still in place, but a short-term sell signal had just been triggered. Where are we now?
Same. It's interesting, and there was and this is actually something I'm writing about in this weekend's newsletter as well, is that we got that sell signal and the market just kind of didn't do anything. It was just kind of trading sideways. We'd rally a little bit and sell off a little bit. And we were just like running right along that 20-day moving average. And so I got a lot of emails like, Lance, you said there was a sell signal, but the market's doing just fine, blah, blah, blah. And that's the thing about technical analysis. It's not right all the time. But what it does do is give you a good indication of when risk exceeds reward, and especially in the short-term basis. And it just took a while for the market to catch up with a seasonal sell signal. And again, the shaded area in the back is money flow. And money flow has been declining for the last couple of weeks, but the market was ignoring that. So we had less momentum, we had less relative strength in the market, and we had this, and the decline in momentum triggered that sell signal. So we said, okay, we've got this sell signal, we've got declining money flows. This potentially sets the market up for a bit of a correction. It just took longer to get there, which happens sometimes. And again, sell signals don't necessarily mean that you're going to have a big correction either. Markets could just go sideways for a period of time and work through that sell signal. Well, in this case, it was doing that, finally broke that consolidation. Yesterday, we cracked the 20-day moving average. And we discussed this on the show earlier this week, is that if you break that 20-day moving average, you're going to trigger a lot of algorithms to sell immediately. And that's exactly what happened. And you can see the market broke that 20-day moving average, and the market just dumped almost immediately out of the gate. And that was all those algorithms just hitting sell signals. Came down to the 50-day moving average. Now we're bouncing nicely off the 50-day here on Friday so far. That's a good sign. We're holding support at the 50. Now it will be important for the market to hold this support level through next Friday. So just because it's bouncing off, this isn't necessarily, we're still on a sell, we're bouncing off support. This doesn't mean it's a buy. Don't go rushing in to buy the market. It's got to hold here for the week. And what would be ideal is that sometime during this week, we actually rally back above the 20-day. Then you can look at that 50 and say, hey, yeah, we held that 50-day support. That's a good buy. And we'll eventually move the buy signal back into place, and you'll be able to add money to portfolios for the end of the year. So, we're looking at this very closely right now. Your next opportunity to buy for the end of the year rally will be when we get the next buy signal.
Okay. All right. So we'll be watching that closely. Let me ask you a couple of questions. So you talked about that green shaded area behind the candlestick chart there as money flows. Can you help people understand the difference or how you're defining that? We hear terms like liquidity, we hear terms like money supply. How is this money flow data being calculated?
This is just simple. This data is just simply tracking. So if I'm buying something, right, money's flowing into it. If I'm selling something, money's flowing out of it. So this is just tracking basically the net differential between the amount of buying and selling that's going on in the market.
Okay, but in this case of the S&P?
The S&P, correct.
Okay, so if you put up NVIDIA, there would be a different money flow chart there based upon money flowing in and out of that company specifically.
Correct, absolutely.
Okay, all right. And is that different than net buy net buyers and net sellers, or is it pretty much the same thing?
No, it's calculated differently. If you're looking at the advanced decline line, which runs on the cumulative basis and those type of things, there's all these kind of different tweaks that happen with different indicators. And this is, I think it was Monday or Tuesday of this past week, I did a whole primer on technical analysis on our YouTube channel and just went through building very basic technical structures for the markets. And the important thing is to keep things very simple, and to really just kind of understand the dynamics. So all of these indicators are great, right? So it's average true range or advanced decline issues or momentum indicators, and there's just literally hundreds upon hundreds of technical indicators. They're all fine. There's not one that's better than the other. The goal is to pick ones that you understand and then apply those. But most importantly, keep it simple. And just, it's really easy to get super complicated with technical analysis, get all these different indicators going on. And then what happens, you start getting contradicting, one indicator doesn't confirm the other. And now you don't do anything because you don't have a good signal. So just whatever indicators you decide to use to manage your portfolio, just keep them very basic and just really understand what they represent, and you'll be fine.
Okay. Another question, leading up until whenever this was, mid-November, you were concerned that we were seeing some negative divergence here, where you were seeing the MACD kind of head down and the RSI head down while the stocks were still rising. And that's a concern for you usually. Now it looks like all three are kind of going in the same direction. Is that correct?
Yeah, well, you still have a negative divergence. The market still what was previously still rising. So now this negative divergence is now starting to equate to this recent correction. The question is this correction over or not? Right. So we just broke the 20-day. We really have just started some type of potential corrective cycle, but it could be over Wednesday, depending on the election. Or as again, one of our concerns is that we have a contested election and maybe the market sells off to, 5,600. We get down towards that 100-day moving average. 5,400 is not out of the question. We could get down to the 200-day moving average. Those are all very possible, very high levels of possibility if we get into a corrective cycle, which would confirm that negative divergence that we've been seeing in both relative strength as well as momentum.
Okay. Then the last technical question is, you were talking about how we saw that big drop this week, and a technical analyst, I would think, would say, okay, that created a gap there, and there's that old adage that gaps get filled. So when you see a gap like that, do you kind of have a higher than normal confidence that eventually it's going to get filled? I mean, yes, the market could correct down further from here, but does that look like the type of gap that's going to act like a magnet over time?
Yeah, well, there's a couple of things that we're looking for specifically now. So, so we've broken a level of key support. The 20-day moving average has acted really for the last couple of years. It's been very strong support for the market. When we take out the 20-day, you generally wind up testing the 50-day or some level of low support. You get back above the 20-day, the market tends to hug that for a while. So what we're looking for now is a rally that takes us back to the 20-day. If it fails at the 20-day and turns lower, there's a risk we're going to take out this 50-day moving average. So we're going to potentially consolidate here a bit. And if we keep failing at that 20-day moving average, get back above it, then you're going to potentially look at a rundown, probably take out the 50, and you're going to be looking at the 100 pretty quick. Now, if that happens, we're going to be getting pretty oversold on a short-term basis. So again, that's just kind of something to pay attention to.
Right. And if we were, chances aren't bad we would get that buy signal that you said you're looking for, which would be that's the time to pile in for hopefully the year-end run.
Yeah, absolutely. The other thing is that maybe everything goes great next week and the Fed cuts rates and the market rallies above the 20-day. Then you've got a clear run back to the bottom of this trend line, which would take you up theoretically to somewhere around 59.68, 6,000. Which is actually our year-end target right now. So 6,000 is our year-end target, and I think that's where we'll potentially get to by year-end. The question is, do we start that move to 6,000 from here, or from the 100-day, or from the 200-day, right? So where do we start that run for the year-end? That's what we have yet to determine.
Okay, and you answered my last question on this, which was, is 6,000 still your year-end target? Sounds like it is.
Yeah.
All right. Well, look, in starting to wrap things up here, there is it looks like we're seeing a potential resurgence of, we'll say, concern over in the UK about gilts there, right? We're starting to see yields go back up, and I haven't had a chance to dig into it a lot, but it seems like folks are attributing it to concerns over, quote, unsustainable, the UK's unsustainable deficit. And I guess two questions. One, is it something you're watching? How much of your focus does it have? And then two, if it really is over concerns of an unsustainable deficit, like how far is the US from a similar position where the bond market starts to get really concerned about our, extreme levels of deficit spending?
Well, again, there's a couple of issues with that. First of all, we're not the UK. First of all, so you can definitely have bond vigilantes in a country like the UK. They're small. They're also not a reserve currency. So we haven't had bond vigilantes show up here in 40 years, and you're not going to, because you're a reserve currency of the world. The dollar keeps getting stronger. So a lot of the concerns that are running around talking about, debts and deficits and these type of things are really unfounded. So both Mike and I have articles coming out. So I wrote one previously, and you and I had gone through this, I think at the time, but I'd written an article about Grant's theory on interest rates, and James Grant had come out and said rates are going higher. And we went through this whole analysis about why that's not the case. Well, so lately we've gotten a ton of emails from people talking about Stanley Druckenmiller and Paul Tudor Jones saying, "Oh, rates are going to go higher. I don't want to own the debt," and start of debts and deficits. And look, these guys have been wrong in the past, so just be careful of just taking their word as oath. But
and I'm not trying to pick any fight here, to be super clear about it, but just for clarity. I interviewed Luke Roman on the channel earlier this week. I'm guessing you might have gotten a few emails from that. He is very bearish on long bonds too. So there is, and I've said this before. I don't think I've seen any topic since I've been doing this over the past bunch of years that people have been more divided on than they are right now in terms of the direction of bond yields and tied to that the direction of inflation.
Yeah. Well, and again, it's whenever there's a immediate concern about something, people are generally very short-sighted. So they're focused on whatever's happening just immediately, and they start extrapolating out, spit that word out. Like extrapolate out what's happening currently into a long-term analysis. A good example of this was 2008. So in 2008, the markets are declining, and everybody assumed that the markets were going to zero. So we just we extrapolate the decline to infinity, and we say this is what's going to happen.
Right.
But the problem with Luke Roman's arguments, the problem with Paul Tudor Jones' arguments, the problems with James Grant's arguments, the problem with Stephen Druckenmiller's arguments are that they don't look at that, they don't function with the data. And again, I don't have a horse in this fight one way or the other, because I don't care from the standpoint of whether or not we're going to have bond vigilantes or not, because all I'm looking at is the data. And if the data ever confirms that we don't want to own bonds, we'll sell bonds, right? And we'll be all in equity. We'll be 100% equities and no bonds. The data doesn't confirm that. And this is where Mike went through a lot of analysis this past Wednesday. It's on our website now. But one of the big concerns is government spending is going to boost inflation. It's not. Government spending has a negative multiplier to inflation. Second thing is that we import inflation from everywhere else in the world, and whether it's the U.S., the UK, it's China. China's economics is a disaster. There's no inflation coming out of China. There's no inflation coming out of the euro. There's no inflation coming out of the UK. Those economies aren't growing. U.S. economy is growing, and it's the only one growing out of all the economies right now. So we're importing their inflation. We're also attracting all of their investment dollars into the U.S., and those are getting converted to reserve currency here in the U.S. But there is no evidence of growth coming out of any of our trading partners worldwide. So as a function of that, we export our inflation to import their deflation. That's how our system works. This is why we outsource our manufacturing jobs, so we can import in cheaper prices. And, again, so you look at this is just creating a regression of the Euro, UK, and China. inflation versus the US, there is no evidence that inflation is rising. In fact, inflation is returning back to long-term trend, which will be somewhere around 2% or less based on economic growth. And we've done this analysis numerous times, and even Lacey Hunt just wrote in his third quarter. In fact, let me just for grins here, let me just pull him up real fast. Bear with me. This is from Hoyson's, Lacey Hunt's latest quarterly report. I'll make this a little bit bigger. Right here, starting here, right? The headline and core inflation rates will continue to recede in an environment of more excess capacity combined with the monetary restraint of the past 2 years, which is still working its way through economic conditions. That sentence right there is the most key, because where Luke Roman is wrong and where Paul Stanley Druckenmiller is wrong and Paul Tudor Jones is wrong is that they're assuming that all the spending that we did 2 years ago is now a sustainable thing. And we're now going to keep spending at that level in the future, but we're not spending at those levels anymore. In fact, if you go back to Mike's article in particular, this is debt to GDP. Debt to GDP is declining. It's not increasing. So that's a function of the fact that the economy is growing at 3% right now. And the level of spending that we're doing is actually declining because all that impulse money that we spent previously during the pandemic in 2021 and 2022 is now working its way out of the system. And so we can run some kind of fun games with this, but let's just assume we didn't do all of that spending. Let's just strip that out for the moment and just say that interest expense and that excess spending for the pandemic, we never did it. Then you're looking at debt to GDP right now being well below long-term trend. Now, look, I'm not saying that debt and deficits are good by any stretch of the imagination, right? This positive trend to debts and deficits is not a good thing because it leads to less economic growth and lower rates of inflation. And there is a ton of long-term history that proves that out. As, again, let's go back to your buddy, Lacey Hunt. Accordingly, the Federal Reserve will have latitude to lower their policy rate further. Moreover, additional cuts will be needed to reverse the multi-year decline in real detrended monetary growth. At the same time, U.S. long-term bond yields will follow the downward path in inflation. Here's the key sentence. This pattern has been extensively researched and well documented. The current evidence of slow growth of real monetary supply globally and its impact on the world economy suggests the pressure for long-term yields to fall is increasing. And he's absolutely right. And again, we've done all this analysis, and I've shown you multiple times the same analysis that there is a historically long-term, very high correlation, 85% correlation between inflation, interest rates, economic growth, and yields. You can't have rising yields in an environment where you have slowing economic growth and slowing inflation.
All right. That's actually a great argument there, Lance. Yes. First off, yeah, you're unquestionably, you're totally on Team Lacey. And for folks that really want a super deep dive into how Lacey sees the world, that was given in, he was the keynote in our recent fall online conference. And so if you want to hear what Lacey had to say, as well as all the other speakers, you can go buy the replay of the conference. To do that, just go to our website, thoughtfulmoney.com/conference. This one, let me put it this way. It's going to be really interesting to see how this plays out. Lance, I understand how you see the world, and it makes all the sense in the world why you have your current bond positioning, given your view of the world. Back to really the main question I meant to ask there, which was, I did ask a second question of, hey, how far behind could the US be? But the first question was, how worrisome, if at all, is the gilt situation in the UK to you right now? Is that something that you think could have any sort of contagion effect if it were to worsen and escape from the UK, or is this just sort of a UK thing and it's not that bad yet?
Let's just think about it this way. Let's say that tomorrow nobody wants to own gilts. Okay, so you're a major institutional investor and you own gilt bonds. That's your portfolio. So now you've got to sell your gilts. Now, where are you going to go and take your money? Are you going to go buy China bonds, Germany bonds, Japan bonds?
Probably depends why you owned the gilts. If they were part of a diversification strategy, then you might not put them in the US, but most people would probably put that in the US markets.
No, but my point is I'm a bond manager, so I'm Fidelity, right? And or not Fidelity, that's not a good example. But I'm a portfolio manager, and I'm running a UK gilt bond fund. So I have a bunch of bonds all across the spectrum because I'm running a UK gilt bond fund, just like we have a US Treasury fund. Okay.
Yep.
But and yes, this is an extreme example, but just follow me through for a second. The question becomes is where do I take that capital, right? I've still got to own bonds, but what bonds am I going to own now? Your only choice at the end of the day is to own US Treasuries. The US cannot go into default because we print our own currency. Again, none of this is good, by the way, the fact that we can do these things. But the point is people claiming that the US is going bankrupt is wrong. We print our own currency. We cannot go bankrupt. There's about $500 trillion worth of assets behind the US government, oil reserves, land, building, everything else that we own, gold reserves, et cetera. So behind the US dollar, and this is one of the arguments, that's really kind of against fiat. People say, well, it's a fiat currency. No, there's a ton of assets behind the US dollar. It's not really fiat. Yes, we can print it. Yes, it's paper. We've all agreed to use that to exchange for currency, but there's a lot of assets behind the US dollar. Bitcoin, there's not a lot of assets behind Bitcoin. It's right. Pretty much full faith and credit of the buyers and holders of Bitcoin. So that's one of the arguments that kind of really gets undermined when you start thinking about the US. But the fact that we can actually print our own currency, we have a lot of assets, we have the strongest economic growth rate in the world, period, and hands down right now. Yes, there's bad effects of having a lot of debt. There's bad effects of having big deficits. That is slower economic growth. Japan is 230% of debt to GDP. It was interesting because Paul Tudor Jones, I've got an article coming out next Friday that we can talk about. I actually took his whole interview with CNBC and I broke it down into his points. But he makes this one comment. He says, take a look at Japan, right? They're running a massive deficit of 230% debt to GDP. They have not had inflation in 30 years. Their interest rates have been zero for 30 years. They finally raised interest rates recently to 0.95%. They're still right on zero for their long-term treasury interest rates. You can't create with 230% of debt to GDP. They're still going, right? They have not gone bankrupt. They have not defaulted on their debt because they can print their own currency. They're a currency issuer. Yeah. They have not defaulted on anything. They can't generate economic growth or inflation. They've got terrible demographics. They have a terrible problem with their welfare program. By the way, exactly all the same problems the U.S. has. There's nothing here to have sustainably higher inflation. You've got to have sustainably higher economic growth, extremely strong employment growth, and rising wages, because wages growth and employment growth and economic activity is what creates the supply-demand imbalance that creates inflation. So if debt is eroding that ability to create economic growth and wage growth, I can't have inflation long term.
Okay. So I get that. And again, I get why that is supportive of your long U.S. Treasury bond position. I'm going to ask my question one last time. We can keep it real quick, which is there any worry that trouble in the UK gilt market could create any kind of contagion just for the financial markets in general, right?
That's the point I was trying to make, is that as a UK bond manager, if anybody that owns UK bonds, if something happened, look, nothing's going to happen to the bond market. This is short-term panic in the markets, and it'll eventually resolve itself. The UK is going to be okay. But the first thing that money would do would go into U.S. Treasuries for safety trade.
Yep, it might. And again, it sounds like you're not that worried, so we won't beat this horse completely bloody. But especially in the credit market, when people start getting worried about risk, right? Yeah. Then people start tightening their lending, and then if it gets bad enough, then it's like, oh my gosh, this person was owning gilts and they've had a big loss, and now they're having forced margin calls, and you can get a contagion. Doesn't sound like you have any worries of that right now. We're talking longer term dynamics, right? So let's just make sure we're all on the same page about something real fast, because this is important. Bond yields can be up or down this week, next week, whatever, right? So bond yields are going to jump all over the place because of economic report, or because the Fed So let me just interject so you can include this in your answer, which is, when we had the whole Liz Truss micro budget and the UK basically went from fine one day to like melting down, like, oh my God, all our pension funds are going to die tomorrow, right? That's what I'm trying to get with the spirit of this question here is there a short-term risk of that type of match getting lit here?
Absolutely. And that's certainly possible. Remember, we had the same issue back in 2011 when we had the whole debt ceiling default thing, and the government said, oh, S&P downgraded our debt. Remember that? We had a short-term spike in interest rates that lasted about a month or two. And everybody was like really worried. It's like, oh my gosh, if they downgrade our debt, we're going to default and everything. It's going to be terrible. And then by the end of the year, rates had fallen sharply because the reality set back in that no, there's really no risk to the debt. So yes, there all these little micro events. I come out with this news like, oh, bonds are terrible, don't own them, and then yields spike the next day because of some employment report, right? Whatever.
Mm-hmm.
That doesn't mean the thesis is right. It just means that right now you got a headline rationale that's running risk. What we're talking about is over the long term, what drives inflation rates and economic growth, and ultimately how's that going to wind up in the U.S. Treasury market. And as long as we're a reserve currency issuer, that's going to be okay. And we're only running 120% of debt to GDP. We're not at 230% of debt to GDP. So this game can run a long time for us to even.
And I hope we don't get there, but we may.
Either. I'm just saying that a lot of these people that are pandering these kind of things are trying to sell you something. They're selling gold, they're selling something else to try to, and again, it's fine, it's just marketing. But just understand that what the message is behind the guy that's giving you the message.
Yeah, yeah. And as you said, don't trade by headlines and don't let your emotions get in the way and all this stuff. I just wanted to clarify whether we had to worry about this in the short term or not. Sounds like you don't think so.
Well, and like I said, look, if the
and granted, that's not a manufactured thing. I mean, the rates are rising there, and the UK is a lot more vulnerable to its gilt yields. But you're just saying, look, it's probably not, panic time.
No, it's probably not. And at the end of the day, if something happens there, it's probably good for treasuries. But look, again, if the data starts to change for any reason whatsoever, and all of a sudden we start looking like we're going to devolve into a higher regime of inflation because all of a sudden we get a massive resurgence of manufacturing capacity in the U.S. And there's obviously some things on the horizon that could cause that. If we did a infrastructure bill to build out nuclear power plants and utility companies all across America to basically provide power for AI centers. And the government says, hey, we're going to throw $5 trillion at this because
it's not the Green New Deal, it's the Nuclear New Deal, whatever. Yeah.
Whatever it is, but we're going to rebuild the entire power grid, which, by the way, would be awesome. So every time I blew in Houston, I would lose my power. But that would change the dynamic. And then at that point, no, I don't want to own bonds, because if you have that kind of spending into capacity, that generates revenue. That's productive spending by the government. That generates economic growth. It creates jobs. It creates the wage growth that leads to higher inflation. So no, I will not want to own bonds in that environment. So if something comes along that changes the dynamic from the current trajectory we're on, and again, talking about money supply, et cetera, then we're going to say, hey, don't want to own bonds. We're going to own stocks, and we're going to be long utility companies, and we're going to be long nuclear power companies, because that's who's going to benefit from it. So look, my job is just to manage money, but what I've got to navigate is these short-term headlines that are running around that says, kind of make crazy statements. And again, you got to remember, Paul Tudor Jones, Stanley Druckenmiller, they've got positions. So are they talking?
Right. Are they talking their book? Right. And yeah. And again, we're done with this, but I just wanted to know if the gilt market was something to worry about. It sounds like you're saying no. You are making a really good case, a repeated case for your long bond position. And so again, for all the folks that ask you and I between each week, is Lance, changing his mind now that yields are continuing to stay pretty high? The answer to that, folks, is clearly no. And Lance, you'll have every week to call audibles on this trade going forward as you want to. All right, look, I got to start wrapping it up here. I'll get to your trades in a second. Real quick, just sort of a public service announcement for folks. If you own companies, and I don't know all the different types, but certainly like a LLC or an S Corp or a C Corp probably, You have to you have to file this year for the first time ever the FinCEN's beneficial ownership information report. And they've been, if you own one of these companies, your accountant probably reached out to you at the beginning of the year and just said, hey, don't forget you got to do this in 2024. I finally just filed mine yesterday. It actually doesn't take all that long. But if you don't do it, in theory, the penalties can be pretty steep. Civil penalties of almost $600 a day, criminal penalties of up to a $10,000 fine or up to 2 years in prison. So just a helpful reminder, folks, if you own businesses, make sure that, now that we're beginning to get near the end of the year, you don't wait till the last second, and you can go fill out that form at fincen.gov. So Lance, hopefully you've done it for any businesses you own.
I don't do that stuff. My accountant does it.
Your accountant does it for you? Okay, well, folks, just make sure somebody's doing it on your behalf. And again, it only takes you a couple of minutes to do once you actually go to that website. All right, Lance, trades. What trades, if any, have you guys made over the past week?
None. What was that website again?
FinCEN.gov.
Yeah.
All right. Well, so, okay, you said, sorry, no trades?
No trades this week. Again, we had kind of reduced our portfolio positions a couple of weeks ago, kind of prepping for the election. So right now we're just on hold till after the election, and then we'll make moves from there.
Okay. All right, we'll move on to our quick little rant, then we'll wind things up. And real quick for FinCEN.gov, Lance, I'm trying to remember what the reason for it is, but I think it's just is it sort of protect against money laundering, or is it to protect against foreign influences owning U.S. companies? Do you remember why we have to fill this thing out?
Just more government intrusion into our lives. So they just want to know who owns every company and who's behind it, and it's just more data overreach.
Okay, so as the zillions more IRS agents, they now have more data.
Much. I mean, if you know what FinCEN stands for, it stands for Financial Crimes Enforcement Network. That's what it stands for. So yeah, I mean, this is just more, kind of an invasion of privacy and more data that they really look. And all this data is readily available. They just want you to fill it out. So now they've got it from you directly, but most of the stuff is already out there.
Yeah. All right. And I just Googled while you were talking. We were supposed to do this to, quote, help prevent illicit activities and protect national securities. So, a pretty general reason for doing this, but like it or not, folks, you have to do it or else you potentially face those penalties that I mentioned there. All right. Well, look, in wrapping up, I want to talk quickly about two concepts, social capital and cultural capital. I think we've talked a little bit about social capital in the past. Social capital can loosely be described as the people in your life who you can rely on if you were to face adversity and need some help, right? This might be how many people do you have you can call at 3 a.m. who will pick up the phone and help you if you've got an emergency. It could be, if you fall down on your luck in some way, shape, or form, the community that would kind of help, support you while you get back on your feet. Could be neighbors, could be family, could be just good friends. I think I mentioned several times in this program before, I used to do live events. We had this matrix called the 8 forms of capital, of which you could, which comprise true wealth, right? Money is important, financial capital is important, but it's just one component, right? And every time we would do these conferences, without fail, when people would fill out this form when they would arrive at the conference, it was social capital is the one that they would score themselves the lowest in. And that just has to do with a lot of, how our society is currently structured. Things tend to be more superficial. We are increasingly disconnected from one another. Culture is a lot more partisan. But anyways, it's something that people feel a real lack of in their lives. And as we've talked a lot about, Lance, humans are social creatures. And without these meaningful human relationships, we feel isolated, we feel depressed, we suffer from anxiety, that type of thing. So anyways, very important to us. And the reason I'm mentioning all this is one of the books I read that I think is one of the best books on the importance of community and social capital and human connection is a book by Sebastian Junger. This is the guy that wrote the book, The Perfect Storm, which became the movie with George Clooney and Mark Wahlberg. He's written a number of other books. The book in particular that really has been meaningful for me is this book called Tribe. And it's based on his time. He'd written a book called War, where he was embedded with a US platoon in Afghanistan for 14 months. And then coming home from that experience, he witnessed how tough it was for the soldiers that he served with to reintegrate into society. And he really wanted to understand why. And one comment that one of the soldiers made as they were leaving, they were actually in Germany getting ready to go home. And the soldier said, "Hey, look, we had a miserable time here in Afghanistan. There's nothing there that us young guys like. Our wives and girlfriends aren't there. We don't have video games. It's super hot. People are trying to kill us. There's no alcohol, right?" And he said, "Can't wait to get home." But he said, "But if there was a helicopter fueled up and they asked us to go back, to a man, we would." And it really stuck with Sebastian. Man, why would these guys willingly go back into that type of environment, given how, quote, miserable it was? And why do they have such a hard time re-equilibrating into civilized society where, everything is a lot easier for them? And what he realized was, yeah, there's PTSD as a bit of a factor, but he says the Army sort of kind of got a formula for how to help folks through with that mostly. He said what it is that they get back into, when you're there in the hot zone, you're in a tribal group, right? We humans grew up in tribes of around 40 to 60 people, which is about the size of a platoon. And it's enough people for you to still know everybody, to still have a personal relationship with everybody there. So you know everybody, you've got a personal connection with them, and you're all working towards some greater good. In many cases, you're facing some sort of adversity, especially in a military platoon. And he's like, you have a defined role, so your sense of purpose is real clear. Your interaction with your cohort there, very clear where you fit in it and why everyone's doing what they're doing. And you know that everybody supports you. Everybody has your back. So, a common refrain you would hear is like, yeah, I don't even like that guy very much, but I know he'd take a bullet for me and I'll take a bullet for him, right? So it's living the way that humans generally evolved to live, right? Where when we were in these tribal groups back in prehistoric times, it was your tribe against the world, right? Against predators, against the weather, against other tribes that wanted to come and get your stuff. So it mimics a lot of the way we're wired to live. Now you get put on a plane, you go back home to America, everything is easy, but it's very superficial. People will smile at you, but they talk about things that don't really matter. Everything's just on the surface. You don't nearly have that sense of immediate purpose. And you have this general sense of like, I just don't feel connected to people. And again, like I might be talking to this guy, he might be smiling to me and saying nice things, but we don't hang out together, or he says one thing but does another. And they feel at sea, they feel lost, and they have this sort of sense of mourning of this real way of living that they had in the hot zone. And this isn't unique to military hot zones. They see this from people in the Peace Corps. They see it from people who have experienced diversity, like having cancer and having their community rally around them, and then they get better, the cancer gets cured, and the community goes off to focus on other things, and they feel this strong sense of life and this guilt of like, I kind of miss having cancer because I felt so much more socially connected. So anyways, great book, really important impact obviously on me. But I interviewed Sebastian, and it's an interview I'm not going to put on this channel because it's such a money-focused channel. But I am making it available to folks on my Substack for free. So if you want to just sign up to the free Substack, you can watch this video. But there's kind of two important things I just want to quickly talk about with you, Lance. One is, I was talking about social capital. That's sort of at the individual level. There's something called cultural capital, which is sort of how your society reacts. And I'll give you a really good way to understand it. If you look at Hurricane Katrina and you look at the Fukushima tsunami, the injury in both cases was pretty similar. You had this massive flooding that basically, created a lot of damage, displaced a lot of people from their homes, right? In New Orleans, we all know what happened there, right? I mean, it became Lord of the Flies, right? You had, looting and crime and, you know, police shooting on people, and you had the horrors at the was it the Superdome there in New Orleans, and you know, it became bedlam very quickly. When you looked in what happened in Japan, there was no looting. Everybody pulled together to help one another. The police were seen as heroes helping people, and really, you know, what was the difference? And the difference was just the cultural, the social, the cultural capital you had in each individual place, right? And so part of this is, you know, trying to you know, have situational awareness about where you live, and hey, when things really get bad here, do I have the social capital where I'm going to have, you know, my own network of people where we can support each other, but am I in a place where we're going to come together in adversity versus turn on ourselves? And what's nice is we've seen some recent examples of this, where I think at least the communities have really helped each other really well. So like in Hurricane Helene, right? Tons of devastation in places that never even thought they'd ever have to experience a hurricane, right? And there's human stories of people coming out about how, you know, communities have pulled together, neighbors have helped folks that have lost one another. Melody Wright, who, you know, appears on this channel a lot, housing analyst Melody Wright, she led a big sort of, you know, fundraiser for her local community that got devastated. And you have all these stories of sort of like individual heroism of people coming together. And so kind of the quick discussion I want to have with you, Lance, is just the importance of both working on developing that kind of social capital, those kind of social relationships in your personal life, to make sure that, you know, if trouble hits you or somebody that you love, care about, that your group will come together and do everything it can to support each other. And then secondly, the larger question of just, hey, am I in an environment where, you know, even the people I don't know are going to do more for good versus for bad, you know, when crisis hits? I'm sure you've got some of your own stories around this.
Well, yeah, sure. But in the Roberts household, we have a simple motto that the best rescue is a self-rescue. So
absolutely.
No, I'm teasing. It's like when zombies come, it's every man for himself. So, you know, the problem is, and I agree with you, is, you know, I used to compete internationally, and I had a group of guys that we traveled all over the world. We fought full contact, and it was, you know, it was great camaraderie. And, you know, and when you don't have that anymore, right, you really miss that type of relationship with people. And it's just, it's very difficult to engender that form of social capital in today's society, particularly when, you know, we're spending so much time alone. This is why you know, social media, you see depression rates going up because of social media. The loneliness rate is going up dramatically because of social media. You know, you know, work from home was, you know, it's like, oh, we get to work from home, this is great. Well, but you lost all that social capital you had working with people at your office. You had those connections, you had those relationships with people that you dealt with every day, and you worked on projects with, and now you're all isolated at your house working from home. It sounds great, you know, at the beginning, but it's really not great in terms of, you know, giving you kind of that fulfillment in life. And, you know, the problem is everything that we're doing is just driving more and more people to be alone. And we can't keep positioning ourselves to where we just are isolating ourselves more and more away from interacting with other people. And then, of course, social media doesn't help when we're all, you know, chastising each other and you know, poking at each other, and, you know, these divisions that we have, we just kind of magnify them into social media. So nobody wants to talk to anybody because you're afraid you're going to offend somebody. You know, that's, you know, that's not really the way to live, and it's not a way to work, and it certainly doesn't lead to a better outcome.
You know, it's so funny. I think that's one of the big lies of social media, or at least the big deceptions, is that, you know, they say we are more connected than we've ever been in human history, which is true, you know, if you include digital connections in there. But there's a huge difference, as we're talking about here, between a digital connection and a in real life connection, right? And in many cases, these digital connections are not satisfying to us on the level that we've evolved to want to be connected on, right? And so it's almost like the more digital contacts we have, the more truly socially disconnected we feel, and that depression and isolation and anxiety kicks in. I used to work at Yahoo, and the division that I spent a lot of years in there was the one that was focusing on kind of the revolution that was happening in broadband at the time, and then mobile, right? And so, and then smart TVs, and the division was called Connected Life, right? And it's funny because, you know, we had this mission carrying us as we were really want to help build human connection. And in many ways, I see all those trends as sort of a force of human disconnection, right? And we almost should have called it disconnected life.
No, we are. We're more connected than ever, and we have fewer relationships with people. And you know, I remember growing up. It just go back to your childhood, and you know, we would leave the house at we would go to school in the morning, and then we'd walk home from school in the afternoons with our buddies, grab our bikes, whatever, and we'd go out. And it'd be a whole gang of kids, driving around, playing, do whatever until the streetlights came on. Everybody went home and had dinner and did their thing, right? But now I see so many kids that are just sitting around. Look, my kids, same way, right? I mean, when social media, when they were growing up, we didn't have social media. So my kids were born in 1999, 2000, through 2003, 2006. Facebook really didn't come along until 2007. So my kids grew up playing with other kids. They grew up with kind of this more fulfilled life. But even as they got older, it was interesting to see that they started having more of the relationships online, and a lot of their friends are online friends. They still have a lot of personal friends that they hang out with. And my son's got this whole group of kids that he played football with, and they still run around, they still hang out together, which is great. I'm glad to see that. But I think that's something that we're losing more and more of. We just, I see kids that are coming up now, and, I meet with a lot of people every day, and I see their kids are just getting kind of more, isolated relative to the rest of the world. And I just don't know how that ends up being a good thing long term.
Yeah. Well, so it's interesting because, Sebastian, who really has, done the research on this and obviously wrote that book, his solution is to intentionally seek out this type of tribal community. So he grew up in a fairly affluent suburb of Boston, said, I don't ever want to live in a place like that again. He now lives in Manhattan in pretty much a tenement apartment building, and has all these great stories he tells in the video about why he chose an environment like that. And he talked about, like, during Hurricane Sandy, he said in this type of building, a lot of apartment dwellers, they don't even know the names of the people who live on the same floor of them, right? You might recognize, your neighbor by face, maybe know his first name, but that's about all you know. He's like, I know everybody in the building here, and there's, it's very ethnically diverse. And he said during Hurricane Sandy, when the power was out, you had, I guess there's a large Hispanic community in there, and he was like, so all the women were making food for everybody in the apartment building, making sure that everybody had food. They would take the excess cooking oil and give it to their kids to go and basically slather it over the fire escapes, so that no looters could climb up the fire escapes. And then some guy from some South American country had a machete, and everybody sort of took turns kind of sitting in the lobby with the machete, just to sort of look scary to anybody that might want to come along and loot the place. So he just said it's like, he said it's loud, it's very colorful, but it's a vibrant place where I just know that if my family ever encounters a time of need, there's plenty of people here that are going to be looking after them, and I've got purpose helping look after people in this community who need help when they need it. So, anyways, folks, if you want to actively learn more about this topic, go sign up for the Substack. I'll be putting the interview with Sebastian on there probably in the next couple of days. And also, too, just to question everybody, we do these online conferences twice a year. As I said, we just did our last one. I do get a lot of requests from folks to do something in person. I think because people are looking to yes, continue to develop their knowledge and exposure to what some of these great thinkers, like Lance and others, think about where things are going, but really more to kind of spend time in the tribe of people who, watch these videos, think about these issues. Not everybody does. What I hear from a lot of people is I really like watching your videos because I try to talk about this stuff with my spouse or with my buddies, and their eyes just glaze over. It's not what they want to talk about, right? So to be in a location where you can hang out with people who think just like you, the same values, the same interests, you know, it's not something that is currently on my radar for 2025. But if there's strong interest in trying to create some real life gatherings of the type of folks that watch these videos, and maybe pull in a few of the celebrities like Lance, Lacey, whatever, where you get to spend some time with them in person too and rub elbows with them as well. Let me know in the comment section below. If there's enough interest in this, then it's something I will guarantee to folks that, or commit to folks that I'll give some real thought to over the holidays here about how we could make something like this happen in 2025. All right, Lance, look, my friend, thanks so much for hanging here for another week. Folks, if you are eternally grateful that a member of your tribe is Lance Roberts, who comes and talks to you here on the channel week after week, let him know by hitting the like button and then clicking the red subscribe button below. What was that little bell icon right next to it? Obviously, if you want some help in figuring out how to manage your financial portfolio, given the trends and issues that Lance and I talked about here, recommend you do that following the guidance of a good professional financial advisor. If you'd like to talk to one of the ones that Thoughtful Money endorses, perhaps Lance and his team there at RIA, then just fill out the short form at thoughtfulmoney.com. You can schedule a free consultation with them. It only takes you a couple seconds to fill out the form, and Lance and his team or whatever advisor you get matched with will follow up with you swiftly. Lance, my friend, I'll let you have the last word here as usual.
Yeah, no, just talking about doing something in live and in person. We're going to have you here in Houston for a live event in February. We're trying to put together the date right now. So yeah, if you're interested in coming to Houston and talking to myself and Mike and Adam, love to have you. So yeah, we're looking forward to it.
That'd be great. And there, once you guys have locked in a date for that, let us know. So we let everybody here on the channel know too. All right, Lance, my friend, thanks so much. Everybody else, thanks so much for watching.